Good evening, everybody. Just going to give it a few minutes as everyone's joining the meeting. Okay, I think we'll start. We've got people perhaps still joining, but this is being recorded and everyone will get a recording who's registered after the event. So welcome to this evening's first session in a series of webinars we're putting on, which is understanding the NHS pension scheme. So this is a real back to basics. What is the NHS pension scheme? Predominantly this one's for GPs. We're putting on another one on the 7th of June, which is going to be more aimed at the hospital doctors. Now, if there's any hospital doctors on here tonight, doesn't mean you have to log off and log back on for the 7th and register for the one on the 7th of June, because the basics of what is the NHS pension scheme is the same. It's just how that scheme is put together, how your benefits may be worked out is slightly different. So if you're going to be registered for both, you'll have a great understanding and grounding by the time you get to the one on the 7th of June. We've then got a couple later in the month in June regarding tax charges, but this is more just a back to basics. I would point out that we are a firm of accountants, and myself, my colleagues Louise Dean and Andrew Burwood, who are here tonight, we're not IFAs, we're not financial advisors. We are involved in looking at our clients' NHS pension scheme for the tax charges predominantly. So we're not looking at the benefits of the scheme in terms of death in service, etc., those kind of things. It's really looking at how it's put together to then enable us to look at the pension tax charges. I'm going to kick off this evening, and Louise and I are going to do the slides in turn. Andrew's here to look at after the chat box and help with any difficult questions. So please make sure that you do put queries in the chat box as we go, because it's probably quite good to look at those every so often rather than leave them all for the end. I'd also say that there's quite a lot of information on our website about pension schemes. We do quite a lot of blogs on it. The NHS pension scheme is really good. It actually has a great member section as well. And we've got a podcast on there about the McLeod remedy, which we're going to touch on briefly tonight, but not spend any time on it. So the idea is that you can look at these series of webinars in addition to the information that we've already got on our website. So kicking off to the first slide, let's talk first about what a pension scheme may be. So you've got predominantly two types of pension schemes, just general pension schemes. You've got what's called a defined contribution scheme. So this is like your normal private pension. You know, you are making, as the name would suggest, a defined contribution of £1,000 a month, £100 a month, whatever, into a scheme, into a pot where it is invested, and then you can use that pot to draw down, buy an annuity pension later on. So that is a defined contribution scheme. And a lot of the tax charges that we'll talk about in later seminars refer to pot values and contributions. And that's what those limits are easily identifiable in a defined contribution scheme. Now, as opposed to public sector pensions like the NHS pension scheme, which is a defined benefit scheme. So although you have set contributions that you pay into the NHS pension scheme, they don't go into a pot of your money that is yours to give you a pension at a later date. Those pension contributions are set by the scheme, but your benefit, what you'll get out by way of pension, is worked out based on the type of scheme you're in and how that scheme benefit is worked out. So NHS Pension Scheme, defined benefit scheme. You may already have some defined contribution schemes as well. You can have more than one, but we're predominantly, well, we are going to be talking about the NHS Pension defined benefit scheme tonight. So we actually have, in the defined benefit scheme of the NHS Pension Scheme, two types of ways that your pension, your final pension, can be worked out. So it can be a final salary scheme, and quite often people talk about final salary schemes. Oh, I've got to have a really great final salary because that's going to be the basis of my pension when I retire. So you've got the final salary scheme. As I say, you still pay the pension contributions based on what the scheme requires you to pay, but the pension you get out is valued based on your final salary. And then the other way it can be worked out in a defined benefit scheme is a career average scheme. So basically you look at what you've earned over the whole life of you being in that pension scheme. Every year your salary, your pensionable profits are all added up. A dynamization factor or an inflation factor to keep it at pace with current level is added on, and you get a proportion of that as your annual pension. And obviously both schemes may or may not provide you with a tax-free cash lump sum as well. So as we said, just to recap, NHS Pension Scheme is defined benefit. The benefits are accrued, so built up over how long you're in the scheme. And they are going to be linked to the length of the service, final salary, or obviously defined benefit, and what you've earned as well. Now, the NHS Pension Scheme has got a lot more confusing recently. So you had what was called the 1995 section of the pension scheme. So anyone who joined the pension scheme before 2008 will have benefits in what's called the 1995 scheme. When the 2008 scheme came in, it was just a change in that 1995 section. So it was just a slight tweak and only applied to people who joined after 2008. But they're both kind of in the same category, 1995, 2008 type of scheme. And then we've got the 2015 scheme, which was an automatic moving across that came in 2015. So we've got these potentially three parts that you could be part of. Now, GPs are what's called practitioners. So they're in practitioner schemes. So you've got the 1995 scheme, and a GP would be a practitioner in that part of the scheme, whereas a hospital doctor or a member of staff working at your surgery would be what's called an officer member, also in that 1995 scheme. So you can see you've got these schemes, and then you've got whether you're a practitioner or officer in those schemes. So not only does each scheme have a different way of how you work it out, but it has a different way again, depending on whether you are practitioner, so that's GP partner, salary GP, locum GP, or whether you're an officer member, hospital doctor, practice staff. Now, some of you on here tonight may be GP partners, and you may have a position with the ICB, and actually that may be an officer post. So you may have some officer work in a section of the scheme and some practitioner earnings in part of the scheme, and they could be worked out slightly differently. So next slide, please. So let's just look first of all in a bit more detail about the 1995 scheme and how this applies to practitioners. As I say, got another presentation on the 7th of June, which will look at hospital doctors, officers, and how the pension is built up in the 1995 scheme for that. So this is a career earnings average scheme. So just going back a couple of slides, you'll remember I'll say that you have earnings every year Those are increased to keep pace with inflation, which gives you a lifetime earnings figure, which then you'll receive a pension from. Now, that lifetime earnings figure, the pension is 1.4% of that. So 1.4% doesn't seem very much. But remember, this is what you've earned since you've joined the NHS pension scheme, going into your 95 scheme, and you would have every year, there'd be, a figure of I don't know, 80 grand is what your pension pay is. That's been uplifted by inflation. It actually gets uplifted by something called dynamization, which is inflation plus 1.5%. So the inflation is based on the government inflation factors, and the 1.5% is an extra benefit for being a contributing member of the scheme. Now, quite often when people get those pension benefit statements, they say, oh, it doesn't look right. The earnings figures don't include when I was a hospital doctor, when I was in training, what you call pre-practitioner service. And that is in there, but you can't see it in your list of career earnings. It's actually, you get this career earnings pot, you get 1.4% of that, and then that pension is uplifted for that pre-practitioner service. So the pension for the pre-practitioner part is valued on your practitioner earnings. So that's pretty good. The 1995 pension scheme also comes with a tax-free lump sum, which is automatically 3 times the pension. So if your annual pension is coming out at 40 grand, then the tax-free lump sum is 120 grand. You are able to give up some annual pension, so reduce the 40 grand in this example, give up some annual pension at retirement to give yourself a bigger tax-free lump sum. The normal retirement age is 60. So that means if you retire any earlier, they're stretching those benefits because they're paying them for longer to you. So they're going to reduce how much they pay, which is broadly around 5% every year for early retirement that you take it. Okay, so that's the basics of the 1995 scheme. As I say, the 1995 scheme was slightly tweaked from people who joined after the 1st of April 2008. Now, people who were already in the pension scheme didn't have to move across to the 2008 scheme. It was a choice if people wanted to move across. I don't think many people did move across because it had a later retirement age of 65 as opposed to 60. But in return, you got a slightly higher pension build up every year as opposed to the 1.4%. Still worked out exactly the same way on your career earnings, as we've talked about for the career average uplift, but you got a slightly higher percentage because you were working till later at 65. So perhaps people who plan to work later made the choice to move across to the 2008 part of this scheme. It's all seen as the same scheme, just with 2 parts to it, the 95 and the 2008. And although that seems a bit confusing, it's quite important in terms of tax that we'll talk about in another webinar, because it means if you moved to the 2008 scheme, you didn't actually rejoin a new scheme, you just moved to a different part of it. Okay, then we're moving on to the 2015 scheme, which I think is the next slide, Louise. Oh, are we going to actually just...
Yeah, sorry, we're going to go through some examples and then come back onto the 2015 scheme. I think
apologies. I will pause myself off and let you take over.
I would take over from here. So just really thought, while it's kind of fresh that Lizzie's gone through how the 95 scheme works, to put it into some context, add some numbers behind it to kind of cement the knowledge, so we're not sort of chopping and changing from 95 to 2008 to 15 and back again. So these are obviously hypothetical, simplified examples, just to put some context behind legislation, as I've said. So to reiterate, we're looking at a GP partner. So this is a practitioner calculation within the 1995 scheme. So as at 31st of March 2021, at the end of that year, which is the NHS pension year runs to, this particular GP had 8 years service prior to becoming a practitioner. So generally it would be you're doing your training, rotating around the trusts, rotating around the hospitals, after which point most tend to go into maybe a salaried role, do some locums. So pre-practitioner tends to be that kind of training period. So it is important that that we know that figure, and that figure is accurate, because it's all built up within the calculations. So on that note, just as an aside, there is what we call membership statement that you can request free of charge once a year from NHS Pensions, and it will list the various trusts that you have worked for, the start date, the end date, and should then highlight any potential gaps that there may be in your record. And it's worth reviewing that quite regularly to spot any gaps sooner rather than later, because it's easier to try and rectify them. So we have 8 years of pre-practitioner service, and then from the point they qualified as a GP and moved potentially into a salaried role or locum or partner, they've then had a subsequent 15 years service. As at March 2021, the pot of their earnings, so as Lizzie said, it's a career averaged earnings, so each year their earnings are cumulative position, uplifted with inflation plus this 1.5%. So at the point of March 2021, for illustrative purposes, they had a pot of £1.3 million. So in order to actually take it to how much pension does that mean? So we take that pot and you accrue the 1.4% as a basic pension. So this is an annual pension amount. So 18,200 is the basic pension on that 1.3 million. We then have to factor in this pre-practitioner service, because as Lizzie mentioned, within the income amounts that you may see on a total reward statement, which we are going to go through a little later, you won't see this hospital pay. So we need to effectively gross up that 18,000 pension to take into account for this fact that you were paying into the pension at that point. So this is where the days become really important. So we take the total service within the pension scheme. Now, this is a whole time equivalent. This is not calendar length. So if there are gaps, those gaps are excluded. If you worked part-time potentially while you were training, it would be prorated for a whole time equivalent. But for ease, this doctor has had full-time service all the way through. So the 2,920 days, 5,475 days combined is the 8,395 days total service contributing to the pension scheme. 5,475 of that is the practitioner, which has generated that 18,200 pension. So we want to increase that by those extra 2,920 days. So that 18,200 becomes just over 27,900. So you can see here that although those earnings are not in that 1.3 million pot, you are generating extra pension for that service. And then, as Lizzie referred to, there is an automatic tax-free lump sum of 3 times that pension, which would be 83,721. So in basic terms, that is how the pension is calculated. What we're going to do is take it forward a year to see how then inflation plays a part in these calculations. So we're now moved forward a year to March 2022. So this doctor in that year had pensionable pay of 150,000, not unusual for a GP partner. With 365 days of service. Now, Lizzie mentioned McLeod at the beginning. So there are complications around this, but again, for ease, we've just treated it as normal service within the 1995 scheme. So we've got an extra £150,000 of pay. We've got an extra year in the service. So we need to take our pot at March 21 and we uplift it by inflation in the year that we're looking at. So it's always at the September within the year that we're what we call dynamizing. So we're looking at 21-22. So September 2021, inflation was 3.1%. So we take that plus an extra 1.5% because they're still in the scheme. So that 1.3 million is uplifted by 4.6%. Now, if you jump on a year to September 22, inflation was 10.1%. So you can see, although the 1.4, as Lizzie said, doesn't seem a lot, 1.4%, actually, when that inflation starts to kick in when it's quite high, it can make quite a difference to the figures. So the 1.3 million uplifted for 4.6%, that becomes 1.359 million. So that is kind of our starting pot. We then add on the extra pensionable pay that they have earned. So the 1.3 at March 21 becomes £1,509,800 at March 2022. So we go through the same practice again. We take the 1.4%, which was 21,137. We still gross up for this pre-practitioner service. It's not disappeared, but we've got an extra year now. We've had an extra year service, so both of those service figures have increased by 365 days. Obviously, if you weren't in the scheme for a full year, they would have gone up slightly different. So then the 21,000 jumps up by £10,500 to £31,706. And again, we generate the lump sum of £95,000. So hopefully that just gives a little bit of context behind the 1995 workings. Now, as I said, these are quite simplistic terms, but when we go through the total reward statement later in the session, you can sort of maybe start to see where figures have come from if you're looking at that yourself. So now let's just touch on the 2008 scheme.
Louise.
So, oh, yes.
It's Andrew. Just before you move on to that next section, we have a question. It's a good time to ask it. So the question is, to get dynamisation in that pension year, do you have to be in the pension in the month of September or any month of the year will qualify?
That is a good question. So if you are in the scheme at any point in the year, you will get some inflation. If you are in for a full year, so if we were in for the full year of 21-22, you would get the full 4.6%. If you opt out, say 6 months through the year, then it's revised for 6/12 of the year. So you don't have to be in for a whole year. It is prorated. In the 95 scheme, you just have to be in the scheme on the first day of the month to get a full month's uplift. So it's not prorated by days. So if you opted out 1st of September, you'd get 6 months worth of an uplift. Now, there are relatively complicated rules around part year dynamizations that we're not really going to go into, but the generic answer is you will get the apportioned dynamization for the period you are in the scheme. Hopefully that answers your question. Thank you, Andrew. Sorry, I didn't pause after my slides. I will remember.
Thanks, Louise.
Okay, so 2008 scheme. So let's just talk a little bit more about this, and then again we'll look at an example. So when we compare it to, I should say 2008 part of the scheme, when we look at the pot that your pension is based on, the treatment is the same as the 95 scheme for practitioners we're looking at. So it's still a career earning scheme. Your pay each year is combined, and there is a revaluation each year plus the 1.5%. So the calculation of the pot is no different. What is different is the benefits that that part of the scheme then attracts. So Lizzie alluded to this earlier, that it has a what we call a higher accrual rate, so you get more bang for your buck effectively. So the 95 section was 1.4%. The 2008 section is 1.87, so slightly higher amount for each pound of pensionable pay that you earn. But on the flip side, there is no automatic tax-free lump sum, and you have to go a little bit longer, an extra 5 years, before you reach that normal retirement age. So that's why looking at pensions and what's right for you is quite a complicated scenario, and making sure you get the right advice, which is not something we can do, as Lizzie alluded to, because of these little nuances. They give with one, but they take away with the other. If you did want a tax-free lump sum, you can give up some of your pension. So every £1 of pension that you sacrifice, you would get £12 tax-free lump sum. And again, there are complicated rules about the amount of tax-free lump sum that you can receive based on your pension. So it's not an option. It's just going to cost you some pension. Same as the 95 section, that pre-practitioner is still uplifted. That is no different. So the main differences are the amount of pension that you get, the lack of automatic tax-free lump sum, and the extra 5 years to the normal retirement age. You can still take your retirement early. You still lose around 5% of pension for each year that you do go. So let's just have a look, another little look at this in an example. Same example, same number of days, same pot at March 21. Only difference here is that you now get 1.87. So they get, I think it works out about an extra 6,000 from memory from the slides. We gross it up for that pre-practitioner, so exactly the same method as we did before. The 24,000 becomes 37. So you've got this higher pot that you could draw as a pension, but what you then don't get is an automatic lump sum. If this doctor said, well, actually, I could probably want, maybe 80,000, I've got something I want to do on retirement, it would cost them £6,667. So their 37,000 becomes 30,600 to get that £80,000 tax-free lump sum. So again, if we flick it through a year, same pensionable pay, the same inflation rates, so that pot is still uplifted in the same way. We add on the 4.6%, we add on the £150,000 pensionable pay. Again, just taking those revised accrual rate and grossing it up for the pre-practitioner service. So calculations tend to work the same way in both schemes, just slight nuances in how much you get across both of them. So let's have a look at this new scheme that came in. So 1st of April 2015, there were wider public sector pension changes. So this wasn't specific to the NHS. There was an overall review of public sector pensions. And as a part of that, they did introduce a new pension scheme. So as Lizzie said before, there were implications around tax charges, or there were no implications, I should say, for the 95 to the 2008. This is not the same, because this is contributing, you are treated as contributing to a new pension scheme. So this was an automatic transfer, depending on how old you were when this was introduced. We had this, what we call tapered protection for members. So 2012 was kind of a cut-off point. If you were within 10 years of retirement at that point, you didn't go across to the 2015 scheme at all. If you were between, I believe, 10 and 12 years away from retirement, you went in at some point between April 15 and February 2022. Those who were further than 12 years away went in automatically at April 15. And as a result, that prompted a age discrimination case against the government, which they lost. And out of that was Bourne McLeod, but we'll touch on that later. So any benefits, so where members were transferred into the 2015 scheme, any benefits that had already been built up in what we call your legacy scheme, the scheme you were in prior to this new scheme coming in, they are there. They haven't transferred across with you. They are still in those schemes. They are still ticking over for inflation purposes, and they are still accessible when you reach your relevant, your normal retirement age. So they are not lost. They're still sitting there. The 2015, again, is a career averaged earnings. So for GPs, this actually doesn't really change how the benefits are calculated. It's a bigger change for the officer members because they had a final salary scheme. They're now moving into a career averaged earnings. Again, your pay is aggregated, combined, revalued each year by inflation plus 1.5%. So not much has changed for GPs in that respect. However, there is again a different accrual rate. So for this, you receive a 54th of your pay as an annual pension. Again, we've got an example just to put some context behind it. Similar to the 2008 scheme, no automatic tax-free lump sum, but you can give up some of your pension, same ratio, every pound pension, £12 lump sum. Now, one of the big changes is the normal retirement age. Now, although the 2008 scheme, there was an increase from 60 to 65, it was fixed at 65. The 2015 scheme is linked to state retirement age. So it's not fixed at any point in time. So 67, potentially 68, potentially 70 in the future. As state pension age is adjusted, the 2015 scheme will follow suit. So that's probably one of the bigger changes within this scheme. You can still go at 55, but again, 5% of pension is lost. And because that normal retirement age could be 67, 68, or even further, that could be a bigger pot of your pension that you're losing if you do take everything earlier, effectively, or as early as you may have taken your 95 or potentially your 2008 benefits. So same process for calculating the benefits, just a different accrual rate and a different state retirement age. So, example. So for this purpose, we've assumed this doctor went in, 2021 was their first year. Very simplified terms, may not have been accurate. So they have pensionable pay of £150,000. So the accrual rate is a 54th. So we take that 150,000, we divide it by 54. So the pension they've earned in that year, £2,778. Now in March 2021, that pot is revalued in the year. So we take the September 2020, because that's the year that we're looking at, 2020-21. 0.5% was inflation at that point, add on 1.5%. So the 2,778 gets a 2% uplift. So at the end of the year, we have 2,834. So there are slight tweaks into how that inflation rate, or when that inflation rate is applied. Let's go forward a year. Pension will pay drop slightly, 130,000. So a 54th, they've accrued £2,407. So we add that 2,407 to the pension we've worked out in the year before, the 2,834, and we dynamise it in the year, 3.1% plus 1.5%, so it becomes £5,482. And each year those pension amounts are added together and added together and uplifted and uplifted. So you will see that there is no reference to service levels. So that is actually another difference which I didn't mention from the previous slide to the 95 and the 2008 scheme, because this is just purely based on your pay, not your service. So effectively, when you've transferred from the 95 2008 into the 15 scheme, the service level stops at that point. And then the calculations now move into this new scheme. So the way we would then calculate the 95 or the 2000 benefit slightly changes once you then become a member of the 2015 scheme. But don't kind of want to bamboozle you too much with examples. Okay, I think there's another question before we move on to the next slide. Can I clarify the loss of accrual if you leave the scheme? Do you still get the inflation uplift and just lose the 1.5%, or do you lose the inflation uplift as well? Now, this was a little bit of a rabbit hole. I didn't want to go down into too much detail because it is complicated. So in broad terms, if someone is in the scheme, let's say March 2021, opts out at that point, so is out for the next year, out for 2 years after that. So they opt back in 22, 23, they opt back in 1st of April 2023. So March 21, they'll get the full year uplift because they're in the scheme for a full year. Those next 2 years, you get inflation uplift because you are still part of the scheme, but you're not contributing. You're not what we call an active member. You're a deferred member of the scheme, so you don't get the extra 1.5% in those 2 years. Now, fast forward to 23, 24, they opt back in for the full year. That 1.5% gets rolled up and put back in that year of opt-in. So it's almost as if you hadn't opted out for inflation or dynamization purposes. Now, you will have had a gap of 2 years of service or 2 years of pay, but the inflation is rolled up when you opt back in. Now, if you're out for more than 5 years, you don't get that roll up of the 1.5% that comes back in. It is complicated, but hopefully that's a more of an overview. There's another question. I have a Phoenix Life AVC that matures when I retired and take my 95. Can I invest these AVC benefits in my remaining 2015 scheme? So effectively, I'm assuming you're talking about transferring that pot into the 2015 scheme. I think someone might have to correct me if I'm wrong on this. I would probably speak to a financial advisor on that, whether that's the right thing for you to do. I think there is mechanisms to transfer into the NHS pension scheme, but I must say that's probably slightly outside of the remit and probably a bit more complicated than what we want to cover off today. By all means, we can put you in touch with some IFAs if you wanted to float that question with them, or Lizzie, if you've got any other thoughts on that question.
Yeah, I think Louise is correct. We probably can't really answer that because it's a financial advice type question as well. But pop us an email and we can either try and get you the answer or put you in touch with somebody who can, I think is probably what we'd say. Thanks, Louise. So we've now talked about the kind of 3 parts of the NHS pension scheme. You could be in, well, you're probably going to be in more than 1 part. You could potentially be in 3. We haven't really talked about added year contracts that people might have had, which means there's another bit that links back to the 1995 scheme. But just be aware you are going to probably be in more than 1 pension scheme when you look at your pension benefits. Now, I would just to reiterate, these are defined benefit schemes, and as Louise has demonstrated, the pension benefits build up every year. So we quite often get, people will sort of say, well, I was going to reduce down before I retire, but of course I don't want my pension to reduce. Well, it's kind of, it doesn't work like that because it's in building blocks. It grows up in blocks. It's you can't lose it once you've already sort of got it in the pot. So I think it doesn't matter what you do later on. Your pension may grow slower if you're part-time because you've got less pensionable earnings, but you'll still bank what you've already got, and if you've moved, as you will have done, from the 95 scheme to the 2015 scheme, what you've got in that 1995 scheme is banked in that scheme and available to draw at 60. It doesn't move across to the 2015 scheme and then all your pension is in the 2015 scheme. So I hope that's kind of clear. And again, I'd say, just reiterate, we are speaking about GP partners here and those in the practitioner scheme. So it may be different if you're a hospital doctor. Where you've got some salary links. Okay, so let's just look at how much this scheme costs, how you pay for your defined benefit. So as a GP partner or a principal, your contract holder, you are self-employed for tax purposes. Now, the NHS pension scheme is a employment scheme, but you are allowed by concession to join that NHS pension scheme as though you're employees. But as a consequence, you pay both the employee and employer contributions because you have no employer to pay that part. But the funding that you receive on your GMS or your PMS contract is all uplifted to effectively include a contribution towards your employer costs. But if you decided to opt out of the scheme, that income doesn't fall. It's the income is the income, and you either decide to be in the pension scheme and use it or part of it to pension, or you decide not to. Salary GPs have an employee, being the practice, so salary GPs will just pay the employee contribution. Locum GPs also should have an employer, although they're self-employed. Again, they're allowed to pension by concession, and the practice that they are working at will pay the, or should pay the employer proportion. There's another slide with some numbers on that. Now, the employer contributions are actually 20.6%, but as a GP partner, you only, and for the salary GPs, the practices only pay 14.3% of that plus this administrative levy, and the other 6% is topped up behind the scheme. And every year they have reconfirmed, no, we're not going to pass on that extra 6% to the doctors, but obviously that is something that they could do in the future. The level of the contributions that you all pay as the employer part are based on tiers, and you've got there the tiers, and you can see they've changed slightly over the recent years. Now, these are all or nothing tiers, so if you breach one band and go into the next, then you pay that rate on all your pensionable pay. But you'll see the top band has come down from 14.5% to 13.5% and further. So they're trying to make the scheme maybe a bit more affordable. So on the next slide, we'll just reiterate how this could work in the two parts of the scheme we've just spoken about. I'm sorry, this is all so confusing. So if you're in the 95 and 2008 scheme, your tier rate was based on your practitioner earnings. So basically all your practitioner earnings in the year added together, which tier rate do you fall into? That's your percentage. And it didn't matter if you'd only worked 6 months of the year or 12 months of the year. In the 2015 scheme, as we said, this is a new scheme, so it has a new way of working out that tier rate, and it's based on annualized earnings. So, you know, if you've only worked 6 months of the year, it will be prorated up and will invariably put you into a higher employee tier rate. So that's important when you're completing your pension certificates. There's an example there. I'm not going to dwell on it because we've got a few more slides to get through still this evening. So here's a sort of quick example that if you are a GP principal, so not a salary GP here, and you're paying both employee and employer contributions, you'll see what those are there worked out on those tier rates. So the total cost is £21,189. Seems like a lot of money. You don't get tax relief at source on those pension contributions, but you are able to claim tax relief. So you pop those figures on your tax return. If you're a 40% taxpayer, which you would be in this scenario, your tax bill will come down by 8,476. And so the net cost to you is 12,713. But you have to pay out the 21 and then you get the tax relief back. It's important, one, that you put it on your tax return, and two, that you put it in the right box on the tax return. We have historically taken on clients from non-specialist medical accountants, and they've put it in the normal pension box, which means it's assumed to already have some tax relief at source. So those clients will have underpaid or underclaimed the tax relief they can get. If you're a salary GP, the employee contributions come off your pay slip. You get tax relief at source under pay as you earn, so your tax bill is lower. If you're a locum GP, how it works is you collect, when you invoice the practice, the employer contribution, then you pay that and your employee contribution over to Primary Care Support England. And again, you have to put that on your tax return to get the tax relief back for the bit that you paid. Okay, right. So this is an important part. So you've paid all your pension contributions, you've claimed your tax relief, but you can't get a pension estimate, or you don't do one of these things. So if you can't get your pension estimates, it may be because you haven't done one of these things. You have to certify your earnings with Primary Care Support England, PCSE, if you're a GP, to be able to get that number, the pensionable pay number, going across to NHS Pension. So this is because PCSE are effectively the employer for GPs, who will administer, keep a record of your pension and your contributions. So all the pension contributions are effectively paid to PCSE. You then annually confirm on a pension certificate what you have earned and what you have paid to them. They will agree that to their records or otherwise. And then once they're all happy that it's all agreed, they will pass your pensionable pay figure to NHS Pensions, who will then work out your pension benefits. So that does cause a bit of a problem and a disconnect, because you're sometimes chasing up PCSE to do something that you need, that NHS Pension needs, so you can get it. And this doesn't apply, as I say, to hospital doctors or salaried staff who have an employer whose pension will go straight to NHS. Pension details and contributions will go straight to NHS Pensions. So Louise is just going to then talk about how the information which is with NHS Pension you can get access to and check.
I do apologise. This is a very wordy slide, so I'm not going to go all through this, but ultimately it is really important to review the pension benefits, to review your membership with NHS Pensions, to be able to timely correct any problems, find out, what's going on, and just so you know, to plan for your retirement. So to be able to review your pension benefits, you will need what we call a total reward statement or an estimate of your pension benefits. Now, this was kind of all digitalized several years ago. There used to be, unfortunately for GP partners, the way to access it via the gov.uk verify system actually closed earlier this year. So unless you have access to the electronic staff record, it's difficult to get a digital copy now. But it can still be accessed by speaking with NHS Pensions on the phone or emailing them, and we've put the details on the screen. Statements are usually updated once a year, normally around August. But if for any reason there was missing information, it hadn't quite been captured at that point, then there's normally a second refresh in December. Now, the issue that GP partners have is the delay in this information being uploaded. So if we're looking at March 2022, you would do your pension certificate, as Liz has just spoken about. You would submit that by the February 2023. PCSE will probably take an age to process it, so it's unlikely that the August refresh, because it normally cuts off around June time, will have that 2022 information included. So you're probably going to have to wait to the December refresh. Whereas hospital doctors, practice staff, it's much more timely because it kind of cuts out the PCSE, cuts out having to do a certificate sort of 11 months in arrears. So we're always kind of working behind, which again, really why you would want an accountant perhaps, or an advisor who understands all of this, because they may be able to give you some more up-to-date information sooner than NHS Pensions. So I'm going to talk through the total reward statement and just again bring it to life a little bit. Now, as Lizzie said, you might not be able to get a copy of it. Normally that is because you've got a year that's missing. So you may have submitted 1920 certificate to PCSE, and then we've submitted 2020, 21, 21, 22. But if some reason that 1920 has gone into the abyss, or it was rejected for any reason and doesn't therefore get processed, although PCSE will process the next 2 years, NHS Pensions can't update your record until that 1920 certificate has been processed by PCSE. So it kind of holds everything else up. That tends to be the main reason, the main flag, if there's missing information on your record, is because you can't get a total reward statement. There are other complexities, as noted on here, but that tends to be the main reason. So let's just have a quick look at what a total reward statement looks like. There's lots and lots of pages to a total reward statement, most of which you can just flick through. I've taken the kind of key pages that reflect what we're talking about today. So the very top, it tells you whether it's the 95 section, the 2008 section, the 2015 section. It will have your membership number on there. It will have the date you first joined the scheme. So make sure that that's in line with your record. So this will be right, way back when. It will tell you the normal pension age. So this is the 95 section. So age 60, 2008, 65, 2015, 67 probably. Now, this is where understanding what we're talking about can really help give the context, because the pay figure there, well, you haven't earned, I can tell you this GP didn't earn £832,000 in any given year. That is their cumulative practitioner earnings. That is their pot figure that's been uplifted by dynamisation, which you can slightly see further down at the bottom of that table. So it's not the pay that you've earned in any given year if you're a GP partner. Hospital doctors, slightly different. The updated to date, again, this can be a bit misleading. So this doctor, I can tell you, was in the 95 until March 15 and then transitioned over to the April 15. Now, the 95 benefits probably have been updated past 2015 because they're still getting inflation every year, but it will only ever say it's updated to March 15 because that's the point they stopped contributing to the 95 scheme. So again, don't panic if that's what it says. It will potentially still be accruing after. So then moving down to the table, so the pension. So this is the annual pension you have built up. So this will be the 1.4% of the £832,394 plus the inflation, plus, sorry, that's already in there, but including the inflation, then uplifted by the pre-practitioner service that we spoke about earlier. This is a 95 pension, so they get 3 times their lump sum as, 3 times their pension as a lump sum. Skipping down a couple, the reckonable membership. So this is the pre-practitioner earnings. Apologies, I've put a slight typo, and I was looking at this today and my mind went blank as to what that is. But apologies, reckonable membership is your pre-practitioner, not practitioner. Now, again, it's whole time equivalent, so it's not calendar years. So that should, if you get a membership statement, tie back to that pre-practitioner. The calendar length membership can be, again, a bit of a red herring because that is the total time you've been in the scheme. So it will include gaps if there were any. So it's not always that helpful when looking at this kind of uplift for pre-practitioner service. And then I think a really interesting one to always look at is this hypothetical annuity cost, because this is what it would cost you if you wanted to buy an annual pension of £17,415 a year. It would cost you £870,000. So people often say, oh, it's such an expensive scheme, it's not worth me being in it anymore. And financial advisors will often still say, yes, it is. And that's one of the reasons why, because I don't know anyone that's got 870,000 or a GP that's got 870,000 to buy this annual pension. It certainly wouldn't have cost you that up to this point. So it still is a generous scheme. It's just becoming more costly to be in it. Slightly later on in the total reward statement, this is probably another good sheet to look at. This is the list of your practitioner earnings. So when Lizzie said right at the outset, oh, my hospital pay is not included, this is what they're talking about. And no, it won't be on here because this is your practitioner earnings. So when you became a salaried GP, GP partner, locum GP, they list it year by year. Now, if you had different roles, so 2009, for example, there's 2 entries, so they would have changed, either a changed employer, moved to a different practice. If it's a locum, they might have gone to a different area. So they will list out the different sources of practitioner pay each year. So the earnings column, 4th column across, that is your actual earnings each year. Next column along, that is the cumulative dynamization factor plus the 1.5%. So that is how much your actual earnings are being uplifted. And every year, that yearly factor goes up again by the inflation plus 1.5%. Moving across along a couple tells you what type of earnings. So is it practitioner? If you've got a concurrent officer, so as Lizzie said, you might be a partner, you might have an ICB role. So you might have something that says CONC, concurrent, because you might have 2 earning sources side by side. And then that one that says NSAY1, well, that is added years, which again, we haven't covered off. But if you purchase an added years contract, effectively you're buying extra service leading to extra pension. So they give you a credit into your pot. And then right at the bottom, they take all those uprated earnings. How it works is they then dynamize by the most recent year, and that gives you your uprated earnings of 832, which, if I just pop back a slide, gives you the total pot. You then take the 1.4%, you then uplift it by inflation. So a really whistle-stop tour of the total reward statement. Now, in the 2015 scheme, I should say, you'll have a separate page. You'll have a replica of this for the 2015 scheme, and a replica of this also for the 2015 scheme. So you should have one bit for the 95 or 2008, one bit for the 2015 scheme. They're the most important pages out of the total reward statement to look at. Okay,
Louise.
so we're back.
Louise.
Yes. Sorry, you've got
Hi,
a question.
it's me again. Just before you jump onto McLeod, we've got another question from Mark. And his question is, what happens to a GP partner who also holds an officer post and accrues pension via this?
Well, because we're talking about the NHS pension, it's complicated. So there are two different ways generally, and there's flexibilities within the pension scheme. Now, it will depend on how much officer service you've got as to how they treat it or which works best for you. So when NHS pensions calculate your pension, they will look at the flexibilities and they will determine which one benefits you most, and they will apply that method. There's two different ways and broadly speaking, option one is that officer concurrent post. So if you've got an ICB post, it goes into this practitioner sheet and it's treated as practitioner earnings. So it's added into your pot, it's dynamized every year, take the 1.4% pre-practitioner uplift as normal. The option two is it's treated as a separate officer membership. Now, all through this, we've been saying this is for GP partners, this isn't for hospital doctors, because they're officers, they have a different way of calculating the pension, they have a final salary link. So option two is that officer post is treated as the officer part of the pension, generates a final salary pension. They work out that pension, they work out this practitioner pension, and they add the two together. Now, which one is right, and it's probably more complicated in theory, it will be reviewed every year. It's not just a all or nothing. They will review the figures year in, year out to see which is the best method for you. So we've banded this McLeod term around.
Sorry,
Lizzie's trying to speak, Louise. She was on mute.
Oh. Not helpful.
Sorry, I was going to just say that if you do have an ICB role, you need to confirm with them whether it is officer or practitioner, because they are the only ones that can determine that. Now, quite often, an ICB role will be officer. So as Louise explained, it will be shown as either concurrent practitioner earnings on that dynamised list, or it will be worked out as a separate officer benefit. Or they may say, no, it's part of a practitioner role on the ICB, in which case it forms part of your pension certificate and it will be pensioned under what's called a GP solo pension certificate. It will be then treated as practitioner income and the contributions will be worked out slightly differently. So if you do have separate roles, and they particularly seem to be with the ICB, I think, it's always good to confirm at the outset, is this an officer position or practitioner position, so you know if you need to add it onto your pension certificate or not.
And the other thing just to bear in mind as well, if we have any clinical directors in the room, that is also a potential minefield. So Mark, I know you know from first-hand experience what that means, but a number of the people joining us this evening won't do. So if we do have any clinical directors in the room, do please make sure you take advice over the pension status of that role and how you are paid for that role before sleepwalking into a particular problem.
Yeah, great point.
Very good points. So yes, so last couple of slides and then we'll see if there's any other questions before we let you go for the evening. So we've bounded this McLeod term, and as I sort of briefly mentioned, it was a result of this age discrimination case that the government lost by forcing younger members of the 95 and 2008 sections into this 2015 scheme either earlier, or for the older members, not at all. So because the government lost this case, they had to undo what had happened. Now, rather than us sit here and talk about it, Lizzie and I have recorded a very insightful, engaging podcast, which we talk about this in a little bit more detail, what it would mean for calculating pension benefits, pension certificates, tax charges. So please do go and have a listen to that. It's only sort of 20-25 minutes. You know, doing the washing up, driving the kids to school, I'm sure they'll love to hear about it. So go and have a little listen to that, and hopefully that will just explain about McLeod in a little bit more detail. So then finally, I'm not really going to go into this in any detail, but you know, we've been talking about all these benefits that you've built up. Well, what are you going to then do with them at the point you decide to retire? Now, there has been increasing flexibilities very recently introduced around the NHS, particularly the 1995 scheme, which then makes it more complicated. So again, seek financial advice. We cannot do this. We can perhaps number crunch, but even that is a bit of a minefield at times. But essentially, you can at any, well, not at any points, but at the point you've got past the earliest retirement, you have a few options. You can draw your pension in full, leave the pension scheme, completely retire, and off you go. Be mindful of, depending on the age, you may lose some of that pension if you're going earlier than the normal pension age. But what you also have now is a few flexibilities around partial retirement. So previously there was this 24-hour retirement rule. So you might not have wanted to give up work, but you wanted to draw your pension. You can still do that. You have to have a 24-hour break. Can be a weekend, can be a holiday, but you need to step away from the practice for 24 hours. And then you can return to work. Now, previously there were restrictions for the hours that you could then work in the following month. They have been removed. You just have to have a 24-hour break and you can draw your benefits in full. Now, you may do that for the 95 scheme, and you could then, if you wanted to, continue in the 2015 scheme. Or we have partial retirement. So this hasn't quite kicked in yet for the 95 benefits, but from October 23, if you reduce your commitment as a GP by at least 10%, then you can take a proportion of your 95 benefits while continuing to accrue further pension. So between 20 and 100%, I think in multiples of 10%. So there is much more flexibility now around retiring. So probably even more key to seek that financial advice, what is right for you as an individual. Someone wants to see the podcast details again. There we go. We don't look like that, unfortunately, now. That's on a good day. So there are the details again, but just head to, search Larking Gowen, head to the little insights section. And as Lizzie said at the outset, all our blogs, all of that information is in that kind of insights section of our website. So please do go, have a read, have a listen.
Just to summarize. Sorry, I was just going to say, just to summarise that podcast, the 2000, basically McLeod means that the 2015 scheme should really now be called the 2022 scheme, because it means everybody has to move over by 1st of April 2022 rather than 1st of April 2015. So it gives you 7 years back in your legacy scheme, if that is what you choose. But as I say, that's quite a detailed topic, isn't it, Louise? So have a listen to the podcast, and then of course you can email us with any questions.
Absolutely, yes. So that covers everything. I don't think there's any other question. So once the once the webinar has ended this evening, there will be a feedback pop-up screen. Please do be as honest as you can, so it helps us shape future webinars. But hopefully it's all good for you this evening. Contact details. Sorry, Andrew, I didn't put your contact details on here.
It's quite all right. But whilst I'm talking, I'm talking, there is a question from Narinda, and that is the membership statement different from the total reward statement?
Yes, that just snuck in there as I turned my head away. Yes, the membership statement is different from the total reward statement. So the membership statement will just purely show you your membership history, dates to and from, who the trust is, whole time, part-time days. It won't pop on there any pay that you've earned. So you kind of want the two statements in conjunction to check the gaps, check that the days look right, but then checking the total reward statement for the practitioner pay to make sure that there's no year gaps in your practitioner earnings, which may be because certificates have gone astray, or I don't know, who knows what PCSE do sometimes. So I don't think there are any other questions now. I'll pop that on screen, but I'm just going to go back, because if you want to note down Lizzie and I contact details. But otherwise, I think that's everything from us this evening. So thank you very much. Hopefully really useful. As I said, please do get in contact if you've got any questions, if you want to talk about anything in more detail, if you want sort of contacts of financial advisors, we can do that for you as well. But otherwise, thank you very much and have a lovely evening.